Hi, it's Alan Laubsch with Fna, and welcome to another Heavy Tales case study. In this episode, we'll uncover what precipitated the 2014 collapse in energy shares. Falling oil prices, we all know, but in fact there's a lot more to the story which both energy pundits and the mainstream media have almost entirely missed. The tipping point for energy was the 24th of June 2014. In front of you is a correlation map of global assets that day, and energy shares were the biggest negative surprise, falling by an exceptional 2.7 standard deviations. You can see this drop far exceeded its 95% confidence level VAR bounds, and it happened just a day after XLE reached an all-time high. Volatility was also at very low levels, exactly the kind of conditions when hidden risk can surprise a complacent marketplace. So what drove the surprising drop? It wasn't oil prices, which were essentially flat. Brent was actually up 14 cents to close at over $114, while WTI, as you can see here, was down a fraction of a percent, and both were close to year highs. The tipping point for oil would only come a few weeks later, starting in the first week of July. Broad equity markets were down, but as we can see, the losses were minimal. The S&P 500 and the Dow Jones were both down 0.6% after reaching a series of all-time highs amidst very low levels of volatility. Similarly, Europe was down 0.8% and was close to multi-year highs with low volatility. Energy shares didn't fall due to specific earnings news or broad investor selling. Rather, energy's fall was driven by sophisticated contrarian investors who saw hidden risk emerge in the energy sector before the mainstream realized it. After researching news archives, I believe the catalyst was an 8:30 a.m. press release titled "Risky Business: The Economic Risks of Climate Change in the United States." Significantly, it was signed by a bipartisan group which includes every major U.S. Treasury Secretary since the Reagan administration, and financial leaders including Michael Bloomberg and Tom Steyer. The 24th of June outlier broke energy's uptrend. It was the sector's canary in the coal mine, and the sector would soon face a perfect storm of slowing growth from Europe, China, Japan, as well as geopolitical tension flaring with Russia's aggression in Ukraine. This would infect broad U.S. markets in August, and we saw systemic risk again flare up in October, coming to a crescendo on the 9th, where we see that energy was the top outlier once again with a 2.85 standard deviation drop, its fifth in 20 days, amidst very high levels of volatility. Markets would continue to drop until Bullard's October 16th dovish comments precipitated a V-shaped recovery, and broad indices reached new records by the end of the month. And yet energy stayed volatile, kept underperforming, and didn't even come close to recovering to record levels. OPEC's 28th of November Black Friday decision to keep production constant added to the panic, and these outliers give a good indication of the most exposed sectors to what I call the energy subprime bubble bust. Markets should not have been surprised by OPEC's decision. It's clear we've exceeded safe levels of atmospheric CO2 by using subprime energy sources, and economists agree that carbon pricing is the most effective way to level the playing field. And yet, paradoxically, energy producers are incentivized to keep pumping as much as they can until these costs are actually imposed. Cascading energy risk infected broad U.S. markets once again on the 10th of December, which precipitated the worst weekly decline in U.S. stocks since 2011. The pain spread to emerging markets the following week, on the 15th of December, and Russia's currency in particular went into a tailspin. The first wave of the energy bubble bust has begun, and this will be a driver of systemic risk in the coming years across all countries, assets, and sectors. Just as we saw in the subprime mortgage crisis, avoiding troubled assets early will be essential. To sense and respond to emerging risks, please sign up for updates at heavytales.com and check our Twitter feeds. Thank you for watching, and please stay tuned to more Heavy Tales early warning case studies.